Hi guys, welcome back to another video. If you're new, welcome. If you're not, welcome back. So in this video, I'll be introducing about healthcare REITs on the pros and cons and the different aspects to take note of when looking at healthcare REITs itself. Moreover, I'll also be looking into the Parkway Reit earnings result. Before we start, I hope that you can hit the like, subscribe, and comment or give any feedbacks on any analysis that you would like me to work on. So, what are healthcare REITs? Healthcare REITs are usually very defensive and considered very stable and sound. Therefore, their shares tend to be priced at a very high premium. So their assets are usually consist of hospitals and nursing homes, with leases being normally triple net basis, which meant that tenants leasing will pay for all property expenses, taxes, and insurance. The leases tend to be long-term as well, giving them the guaranteed income. So healthcare assets tend to hold up well in recession as they provide basic healthcare, which is essential regardless of any recession or in terms of good economy. But assets of hospitals that specializes in non-essential healthcares like plastic surgeries might have higher correlation in terms of the performance of economy. For healthcare REITs, although they are considered safe, there are also definitely challenges and good things that we can talk about for this kind of REITs. So what are the challenges for healthcare REITs? So firstly, unlike other REITs, they do not really allow frequent rental reversion growth. So therefore, they lose out during an upcycle in the economy. Moreover, they can only depend on rental index to inflation and variable rents depending on the revenue earned by the tenant, because their tenants tend to be on a long term. So therefore, they have to depend on the formula for their income that they receive. So as I mentioned just now, hospital REITs consist of mainly two asset types, which are hospitals or nursing homes. If the REIT consists of hospitals, they are good because they are very hard to replicate and would need to build up reputation in order to have good income. However, nursing homes, on the other hand, is much easier to replicate and do not cost that much to construct. So for healthcare wise, respective countries have different dependent on the government insurance program for healthcare. Therefore, it's important to ensure that those countries' program do not actually affect the people's affordability for healthcare. So the last challenge for healthcare REIT is that usually they always depend on one tenant. So it's important to read up on the hospital operator earnings to ensure that they are actually doing well, so that they can pay for the rentals. Okay, so what are the pros for healthcare REITs? So the first thing is that as different countries have aging population, more and more people would have to spend on healthcare. Moreover, as country improves in the economy and people get wealthier, therefore more willing to spend on healthcare. Lastly, unlike other REITs, investors do not have to worry about the assets being lack of demand because more and more people would require these facilities. So let's take a look into the recent earnings for the Parkway Life Reit, which is a typical example of a healthcare REIT. So taking a look at their profile, majority of the portfolio is the hospital, followed by 34.4% is nursing home. However, if you look at the assets diversified into Singapore, it's divided into Singapore, Japan, and lastly, Malaysia with a minute amount. So majority of it is in Singapore, with Parkway Hospital Singapore Private Limited as the top tenant at 60.7%. Moreover, if you look at the lease expiry, compared to the other REITs, they have way less expiry. As you can see, that not more than 2.5 leases are due to expire in the next 5 years. As you can see, for the full year 23 to 27 is only 1% or 1.3% up to 2%. So it's way different from the retail or industrial REITs where their lease expiry is at a much higher ratio. So looking at the Singapore portfolio, for the master lessees of the Parkway Hospital Singapore Private Limited Group, they are under this huge group called IHH Group, which is the IHH Healthcare Group. So they are a group that is very big with 80 hospitals over 10 countries. So for Singapore wise, they actually have Mount Elizabeth Hospital, Mount Elizabeth Novena Hospital, and Gleneagles Hospital, which are well-known private hospitals for various healthcare reasons. Moreover, they also have Parkway East hospitals and other primary clinics. And they also have other huge assets overseas, which shows their experience and how stable they are as a sponsor. Okay, so looking into their Japan properties, they are very different from Singapore properties because in Japan, they are mostly nursing homes. As you can see, there's 57 high quality nursing home properties. And the good thing is that their properties are mostly downside protected and their rental reversion provision are only on the upsides. So another good thing is that because Japan, as you know, is one of the highest aging population, so therefore demand for nursing home in every region definitely will go up as time passes. So another good thing about having these nursing homes as assets instead of hospital is that it helps the REIT to diversify in terms of the number of key tenants. Because if you have looked back into the hospital only has 1 or 2 tenants. So the REIT is highly dependent on them for the income, whereas nursing homes will help to diversify into much more tenants. As you can see, they have actually said that the top 3 tenants actually contributed less than 40% of the total revenue from Japan. So it here shows again about the diversity through nursing home assets. However, for nursing homes, as I mentioned previously, they are much more competitive and much more easier to replicate as compared to hospitals. So therefore, competition for this kind of assets would definitely be much higher as compared to hospital. So for their Malaysia assets wise, it's quite insignificant. As you can see, it's only one real medical center with a very small land space of 3,450 square meter. And you can see that in terms of the appraisal value between the Japan, Singapore, and the Malaysia property, Malaysia is only at a very small value of 6.3 million. So to me, I feel that it's not a big concern in terms of the performance of this small medical center. Okay, so now that we know more about their assets, let's take a look at their key highlights. As you can see from the key highlights, higher gross revenue as expected from this kind of good REIT with good assets. So their revenue increased 7.7% year over year, while 14.2% from comparing second half from last year. And the result was the revenue increased due to higher rentals or better performance from their Parkway hospitals. Moreover, they have also started to hedge the net income from Japan because the Japan yen, as you know, has improved quite a bit throughout the years. Moreover, their DPU has actually went up by 2.7% year over year to 7.32 cents, whereas for the full year has increased by 2.1%, and their gearing ratio is at a healthy rate of 36.4%, while their interest coverage is at a very high value of 18.3%. 18.3 times, which is much higher than normal rate because their all-in cost of debt is only at 1.04%. Now let's hop on to their year-over-year results. As you can see, gross revenue increased by 7.7% year-over-year, whereas net property income increased by 9.6% year-over-year. However, the expenses actually increased by 5.2% due to higher management fee, as you can see, attributed from the better performance from property income and the property values. If you look at the tax return or the distributable return for this period, it has dropped by a concerning huge amount of 87.6%. So, by looking more into the details, you can see that the fair value of the investment property has changed quite a bit. As you can see, for the full year 2021, it increased by 239 million, whereas for 2022, it has dropped by 59 million. So this is due to external factors and these are paper values. So therefore, they should not be a concern for shareholders as they are just there for accountability on changes in the assets values. Unless they are REITs with high gearing ratio, then definitely all these kind of asset values will have to be accounted for because drop in assets will naturally lead to higher gearing ratios. So as for their DPU wise, they are a very long-term stable REIT. As you can see, they have constantly grown throughout the years and have grown by 127.5% since IPO from 2007. So imagine you are a shareholder from this period until now. Imagine what would be the return. Moreover, they have also grown by the share price have grown by 250% of capital gain throughout the years. However, past performance doesn't guarantee future performance. Well, one bad thing is that they are currently always constantly priced at a very high premium. From 2021, it was priced at a premium of 116.5, whereas for now is at 61.4. And at the average share price of $4 is at a range of 71.8. So this gives a very low DPU for Parkway Life Reit. So you have to weigh on what other investment that you would like to make. So therefore, with the share price at around $4 range and the distribution at announced of 7.32, the annualized per lot or 1,000 shares of dividend will be 146.40 cents. And if you calculate with at a share price of $4, you will get a dividend yield of 3.5%. So it's actually quite low as the yield is similar to some banks' interest rate now. However, if you believe that interest rate will drop in the future and believe that hospitals and nursing homes are upcoming in demand, then Parkway Reit might be a good REIT to consider. So, looking at their debts, debt-wise, they are financially sound with only a small amount that needs to be refinanced for the year 2023 and 20% at 2024, as they are stated how they are going to renew those loans. Moreover, at the 36.4% gearing ratio, they are still at a very healthy level with a decent amount of headrooms to borrow in the event if they require. For Parkway REIT, in my opinion, the asset valuation would not drop as much compared to other REITs such as Manulife, which has assets dropping more than 10% in valuation. So therefore, in valuation wise or worries that it might affect their gearing ratio, to me, it shouldn't be that much of an impact. So in conclusion, Parkway REIT have assets and strong sponsor group which makes it very resilient and stable throughout the years regardless of macroeconomics, therefore making it a very safe REIT, but definitely that's the reason why they are priced at a very high premium compared to other REITs throughout the years. However, with the expansion into Japan for nursing home, one slight risk would be the decrease in the Japan yen to SGD, which will result in lower revenues from their Japan assets. Moreover, being a safe REIT, it tends to be priced at a higher premium. Therefore, with dividend yield in the range of 3.5%, it might not sound very attractive to many investors. I hope this video brings clarity to healthcare REITs and hope that you have enjoyed this analysis. Please give me a like, subscribe, and comment on any other analysis that you would like me to work on. You can also watch my previous analysis on Mapletree Industrial Trust third quarter recent results, which I follow up from their Q2 actions. So thank you so much for watching, and I'll see you in the next video.